Achieving balance as the economy transitions towards non-mining sectors, increasing confidence and managing the impacts of decreased growth and structural change in China will be among the main challenges facing Australia's economy over the remainder of 2014. Internationally, post-GFC recovery is well underway in the US and Europe, with consumer confidence returning in both markets, while structural reform is a high agenda item in North Asia. In this session, we'll describe the first quarter performance and outlook for the Australian economy in 2014. Review the Australian share market sectors likely to perform strongly over the remainder of the year, and discuss the share market sectors and companies likely to perform strongly in the US, Eurozone, Japan and emerging markets. Michael Pollock presents this report.
The Australian economy continued its steady performance across the first quarter of 2014 with an inflation rate of 2.9%, up from 2.7% in the December quarter. This was below most expectations, but still prompted the RBA to lift its inflation and growth forecast for the year to December 2014. The continuing challenge for the RBA is achieving balance as the economy transitions away from the resources sector towards non-mining industries. The core of the problem is that non-mining sectors were subdued during the mining boom in order to keep inflation under control, and confidence must return to those sectors in order for investment and employment to increase. However, signs of improvement began emerging in the first quarter of 2014, with employment up 18,000 year-on-year in March, after an increase of 48,000 in February. The unemployment rate also fell from 6.1% to 5.8% in February. Average house prices have risen 10% in the past year and are around 5% higher than the previous peak in 2010. In the first quarter of 2014, home building approvals were at their highest rate in 30 years. Qadari Securities' Michael Qadari says the recent strong growth in the property sector is unlikely to continue.
As there's more approvals in terms of housing and buildings, there's more jobs being created and they require more finances, which means we're not going to have the same, growth that we've had in the past 4 months or last year in property. I see that sector being quite important, but yet again, the government's trying to, see what are the industries or what are the sectors they can pretty much distribute that mining growth into.
The consensus among commentators for the remainder of 2014 is for continuing growth in inflation, with employment to remain relatively unchanged. Although the first quarter of 2014 saw employment increases in non-mining sectors, growth in employment for the year overall is likely to be offset by job shedding in the mining sector. The RBA said in its February statement on monetary policy that it expects an inflation figure of 3.25% for the year ended June 2014, up from a forecast of 2.5% in its November statement. Platinum Asset Management's Douglas Isles says that the current high demand in the real estate market could prove to be detrimental in the long term.
Living here in a country which has basically the highest wages of any country in the world, and our property trades on a higher multiple of wages than almost any other country in the world, then it's hard to say that we should be having a new property boom from the levels we're starting at now. I, and I'm sure many people watching this, own property in Australia, so we don't want to talk it down. But the starting point is quite elevated, and therefore I think the concern would be if that housing boom is driven by speculation rather than need. Then it could be a destabilising influence rather than a positive.
Qadari warns of the impact of a slowdown in China as the country makes the transition from infrastructure-led growth to a consumption-driven economy.
China's growth slowing down, and it will slow down. So the forecast for 2014 is around the 7% mark. China's trying to keep it at 7.5%, but the stock market hasn't done very much well over the past year. And consumer confidence or retail sales are actually down in China.
Despite the slowdown in the mining sector, federal government budget cuts, lower export prices and a high Australian dollar, the official cash rate is expected to remain on hold at 2.5%, where it has been since the first quarter of 2013. These negative pressures have been offset by slowly improving employment figures, strong consumer spending, an increase in home building approvals and mortgage applications, and increasing inflation. Isles predicts that the Australian dollar will weaken over the remainder of 2014.
We find it hard to justify the value of the currency on any medium-term valuation methodology. Only really the terms of trade supports it. So I think if we take a 5-year view from here and start to say, well, what's going to change as the currency recedes, there are businesses and industries that will become more globally competitive as the currency recedes.
The Australian share market was one of the strongest performing markets in the world across the first quarter of 2014, despite mixed economic data from the US and uncertainty around the dispute between Ukraine and Russia. Isles says the Australian banks were the star performers in the local market, helping to offset the slowdown in the resources sector.
The Australian market was up about 2%, driven by the financial side of things rather than the resources side of things. And I think at the end of the day, the banks are a bigger percentage of the market than the resource sector is, and they kind of bounced back quite well this first quarter of the year.
Kidari notes that Australia's low interest rate environment helped construction, finance and housing stocks across quarter one.
These are the key sectors which are in line with interest rates. So, as interest rates are lower, more money is being put into these sectors or investments. And, I think, looking at companies in those sectors that have done very well during the GFC and prior to it is the key in terms of making the right investment choices and decisions.
Historically low interest rates and increased consumer and business confidence are expected to be major influences on share market performance for the remainder of 2014. Kidari explains that lower interest rates encourage more investment in property and the stock market.
I see interest rates being at 2.5% as being very much positive for our stock market, very much positive for our property market, and I don't see them moving up anytime soon. So, more consumer confidence, more retail sales, and more business confidence will mean that the market will continue to rise as well. So it's all in correlation, and sometimes, the stock market's a leading indicator of our economy. So I think if the stock market's done very much well over the past year or 2013, you'll see our economy follow too. So I see the markets doing considerably well this year and next year.
Kidari sees the uncertainty over China's ongoing growth prospects also having an impact on the Australian market.
The volatility at this stage is coming through China. So I guess the whole world is questioning China's growth level. So can they keep growing at 7.5%? It's very unlikely, and they've got to keep creating more jobs. It's a bit of a challenge for their own government, and everything in China will affect our market in the US or Europe. But I think China's quite lucky as the US economy's picked up and the European markets picked up. The stocks in the resource mining services sector will significantly be affected upon China's growth or decline in terms of their growth.
Isles says the extent of the impact of interest rates on the Australian share market will largely depend upon the dollar.
The big dynamic here is how the interest rates interplay with the currency as well, because people are talking about a tightening coming later, but then the currency's gone up in anticipation of that, which creates more challenges for exporters and perhaps means the interest rate rises are prolonged and there's a bit of a reflexivity. And then you question the impact on the economy. So there's a whole lot of things going round in circles, if you like. But in general, low interest rates are good for asset markets. I would be concerned if it creates too much heat in the property market. But I suspect that can be controlled through regulation rather than through interest rate rises if the rest of the economy still appears to be sluggish.
Kidari notes there are a number of key sectors to watch over the remainder of 2014.
The sectors that we are looking into at this stage are your telcos. Because of our need for data and infrastructural changes, retail, as consumer spending is actually increasing, retail sales are increasing. Lower interest rate create that environment for the property market. So the property market did extremely well last year, and in the first couple of months this year. So property market's very good. Financials are extremely good too.
Isles points to opportunities within the sectors for which Australia holds a competitive advantage.
You look at things like agriculture, you look at things like education, you look at things like tourism. We should have a competitive advantage in financial services given the extent to which we have superannuation assets under management. You could look at some of our sort of healthcare and medical, but the question is, can you capture that in the stock market?
Sectors expected to underperform across the remainder of 2014 include mining, particularly mining services and construction stocks now that the sector has shifted out of the construction phase. Also sectors that are likely to be affected by a slowdown in China's growth, which again include mining and resources companies. The US economy is now well into its post-GFC recovery phase, indicated by increasing consumer confidence, rising real estate prices and reduced unemployment. The outlook for the US share market is positive for the remainder of the year, with the Dow hitting record highs earlier this year after trending upwards for the past 5 years and interest rates remaining low. The market has been anticipating the recovery for some time. Kidari explains that after a difficult period post-GFC, the prospects for the US market in the months ahead are good.
They've had a heavy sell-off in the tech market, but I still think in terms of consumer confidence has picked up, business confidence picking up in the US, unemployment rates are dropping, lower interest rates. These are all conditions that stimulate growth in an economy, and the market's done very well, and now I think their economy is significantly picking up. So I think now's a good time to invest even in the US market.
Isles says that a major event for the US share market in recent times has been the development of tight gas deposits in low permeability rock.
There's a lot of discussion about shale gas, shale oil that we hear about from the US, and that we think is very significant. So energy costs have come down to levels that are not far off what you see in the Middle East. That's very significant. It's a great advantage, or competitive advantage, that the US has regained there. And what we think will happen is we think we'll see investment, capital expenditure by companies looking at things like pipelines, refineries. We even see some manufacturing almost coming home, if you like.
He adds that the US technology sector is also showing positive signs thanks to opportunities in the area of smartphones.
We have a number of investments in the technology sector. So we own companies like Intel, companies like Google, eBay. They're among some of our larger holdings in the US market. There's a big trend around the smartphone predominantly, but a huge trend there which is at its early stages, and we think the growth potential for some of the companies is underappreciated, and in the case of Intel it's a transition story. The company has missed that mobile trend so far. Their chips have been optimized for desktops, laptops, servers, and as they optimize their chips for the mobile market, we think there's a big growth period ahead for Intel.
After a positive 15 months to the end of 2013, Japan's share market was down around 9% in Australian dollar terms for the first quarter of 2014. Isles says that the slow implementation of structural reform promised by the Japanese government has concerned foreign investors.
When Abe came into power in late 2012, his policy was around three so-called arrows. There was monetary policy, that forced the yen down, that was very good for exporters, fiscal spending, and the final third arrow is probably the vaguest of all, but that was around structural reform. There's been very little progress in that regard, and we think that basically some of the foreigners that have been trying to capture a renaissance in Japan have been disappointed and chosen to head for the exits.
Despite the slow pace of its fiscal reforms, Isles still sees opportunities in the Japanese market.
When a market is as out of favour as Japan has been over many years, there are lots of opportunities where there's mispricing. If we look at the market at broad level, though, the Japanese market only trades at a small premium to book value. So the entire system, if you like, and the innovation and creativity of the Japanese is not being given much credit. On a PE basis, it's as cheap as it's really been against the rest of the world historically. So you could make a case at a market level that we should see there is potential in Japan.
Eurozone share markets performed similarly to the US across the first quarter of 2014, with a rise of around 2%.
There's certain countries in the EU that will continue to do well. Germany's doing extremely well. But then again, Germany's a high-level manufacturer, and they're taking advantage of lower interest rates and, the improvements upon economies such as France or, Spain or Greece that, you might see come forward.
Isles believes that Europe potentially offers more investment opportunities than the US.
There's a whole lot of indicators that suggest that we are in a position to move forward for Europe, so I think that's good. And the valuation gap to the US is wider than it normally is. So from a stock market perspective, we can find investments in Europe that we can be comfortable with.
Kidari suggests keeping an eye on manufacturing industrials.
Especially, companies within the German market, which some, tend to have a very much high return on equity. Their earnings, in terms of their growth-wise, it sometimes is higher than the market caps.